Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. This is our first episode on our first ever podcast. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Vice President of Content.
I'm Brad Simmerman. I'm the Chief Analyst and Managing Editor of the Cabot Wealth Daily. Chris, right off the bat, I want to ask you a question. So retail sales came in today worse than expected, markets drifting a little bit lower. They were pointing to durable goods orders and vehicles as being a big driver behind that. What's the last major purchase that you made? So appliance, let's say $500, $600 or above.
It wasn't that long ago. We ordered a new dining table, or my wife did. It was a couple months ago, but it didn't show up till last week. So I think that was the last one that was that big. How about you?
So I bought a grill a couple of months ago. I mean, we're just relatively new house, finishing the backyard, etc. The reason that I ask is that I'm sort of working on a theory that some of the weakness in retail spend is attributable to everybody being flush with cash after the pandemic stimulus and essentially getting their big purchases out of the way. Because I think for most consumers, what people were running into is like, all right, well, it took me 6 months to get my last piece of furniture. I don't really want to deal with whatever snarls are left in the supply chain. So I'm just going to hold off on any big purchases. I think that the retail sales could be pointing to a weaker consumer than is really the case. I don't know, but anecdotally, just sort of working on that theory.
Anecdotally, I see zero sign of a weakening retail experience. Just going to get Easter goodies for my kids at Party City last weekend. The shelves were almost empty because they'd been wiped out. Granted, this was 2 days before Easter. Just shows that I'm sort of a procrastinator, which I already knew. But well, yeah, and it was packed. Everywhere you go is packed.
Yeah, I'm seeing the same thing. My area of Phoenix is really rapidly growing, so all the retail spots are brand new. So there's also that sort of novelty component to it. But I haven't been in a retail store that hasn't been swamped or understaffed, or it hasn't shown any kind of sign that the consumers stopped spending or is really tightening their purse strings at all.
No, it seems like housing market is where you hear about it most, but that's a different conversation, obviously.
Yeah, with mortgage rates going down, though, that seems to be strengthening a little bit. I mean, a lot of this, and Mike Santolo, chief analyst of Cabot Growth Investor and top 10 trader, has talked about how a lot of the technical signals that have always worked in the past sort of didn't work in the most recent market, which is weird, right? But it's certainly not unprecedented. I think we just have to go back maybe further into the past to find sort of echoes of what we're seeing now. But actually, I think that'll lead to a good transition, because one of the things that we do on Street Check is step up each week to defend takes that are sort of out there or wild or maybe a little bit unexpected.
Chris, a segment called Defend the Take.
Defend the Take. Chris, this week, it's your chance to defend a crazy take. And your stance is that, unlike basically every other time in market history, this is not a sell in May month or not a sell in May year. So you have 90 seconds to defend the take, and your clock starts now.
Okay. This isn't that crazy a take when you look back at just the last 5 years. Average gain so the sell in May, go away thesis is that sell in May, disappear from the market, or don't buy much between May and November, or end of October to the beginning of November. Market's worst 6 months historically. Well, the last 5 years, the average gain during those 6 months has been 5.2%, total return 26%. During those 5 years, the total return period for the entire time is 55%. So if you had sold in May, gone away, you'd have missed out on almost half the gains from the past 5 years. Last year, May through October, was better than, or I should say less bad than January through April was. And this year, I everyone's saying, back half of the year, that's things they're going to be much better. And who knows what will actually happen, but it's shaping up that way. Inflation down to 5%. The Fed, we'll get into what they're going to do, but might be loosening a little bit on their hawkish stance. And the market's forward looking and looking for past what may or may not be a recession or a very mild recession at worst. And then also, like you said, retail's holding up.
And time.
Okay.
Not particularly compelling. I think if you maybe had another 30 seconds, you could have nailed that one. So what's your closing points?
My closing point is, I think people should buy this May or now. The market's been stuck in a range for a while. There will be a breakout coming soon. Could be to the downside. A lot of that will probably depend on earnings season. But we already got enough to a good start. And again, we'll get to that in a second. But I think the back half of this year is going to be strong after 16 to 18 months of a bear market. And buying in May has been a pretty good bet the last 5 years. I think it'll continue to be so this year.
All right, that's an impressive stick save from you with that extra 30 seconds at the end. It sort of reminds me of something that Tom Hutchinson recently wrote in Cabot Dividend Investor, which was nobody knows what the next 10% move in the equity markets is going to be, but the next 100% move is going to be up. I mean, that's the long-term trend of the market, right?
Right. Yeah. I mean, there could very well be more weakness ahead. I'm just talking May through October. Maybe the market will weaken and be weak, through the spring into the early summer. Summer is notoriously sort of a dead time in the market, but I think even if so, it'll make up for lost time in early fall. So yeah, I think buy now or invest.
Right. I think that's an optimistic take, certainly. So
I'm an optimist. We need to establish on the first episode who's the optimist here. So
yeah, I'm the sort of borderline perma bear, and he's the optimist. So
yeah,
I'll be the sort of negative voice of reason. I'll be the devil on the shoulder for
the
duration of the podcast.
I think that'll reveal itself in this next segment. Our second segment is what we call the big three stories going on in the market, or sort of front of minds for investors. Number one, CPI, like I just mentioned, came out the other day. March inflation was 5% down to 5%, as high as 9% or 9.1% last summer. It was lower than expected. How big a deal is this? I guess the market is kind of telling us since then it's not that big a deal. What do you think?
So Jamie Dimon, CEO of JP Morgan, very well respected voice on the street, smart guy. He came out, and a lot of his talking points with JP Morgan's earnings, which we'll touch on later, were very similar to, I think, what the Fed speak has been lately, which is, hey, this inflation isn't as bad as everybody was afraid of, but it's going to stick around for longer. The economy is still resilient. So what we're going to run into, or what we're going to experience, is probably more of the higher for longer. Rates stay elevated until inflation gets back down to 2%, but probably not going to see wild pricing swings. I know the most recent CPI print was driven a little bit higher by cost of residency, cost of rent and mortgages and things like that, which tends to be lagging. But a lot of the core inflationary drivers, energy, food prices came down, which has the unfortunate side effect of sort of turning the market into a slog, right? Like, there's no big splashy data point that's going to come in and juice the next bull market rally. It just seems like it's going to turn into a grind, which I think the market is reflecting today. We're down 200-ish points in the Dow.
My question is, what is the number that CPI can get to where one of these Fed members won't go rogue like Chris Waller did today, and come out and throw cold water on it. Like, what is that number? He came out and said, still much too high, and my job is not done. Inflation is still above target. Monetary policy needs to be tightened further. He was concerned about core inflation, 4 straight months, 0.4% or higher. Every single month this happens. People react, the market reacts like, oh, that's a good thing, right? And then some Fed member comes out and says, actually, no. Like the worst sports teams, you always hear someone in interviews, there's someone on the team chirping in the locker room like, well, if my coach did this, or we're not on the same page. Everyone has a voice. Instead of the most effective sports teams are one voice. The coach speaks, everyone's on the same page. The Fed is like a bad sports team where no one's on the same page and they all say different things every single week. It's frustrating.
Yeah. I mean, my tinfoil hat is that's a smokescreen, right? Like the Fed doesn't exactly know what they're doing. So if you run a bunch of screens out there, you can sort of operate behind the scenes, and you've got these competing narratives. Sub 4%. I think that's the number where you start seeing more Fed voices coming out and saying, okay, we've done enough. We're below 4%. We're going to let this sort of work itself out. But we're sort of at time for this chunk. But one of the things that I wanted to touch on was that, when Powell came out and spoke after the last Fed meeting, he essentially said, hey, hopefully this Silicon Valley Bank fallout will end up tightening banking standards and will have the equivalent effect of a rate hike. And I think as bank earnings are showing us that that's not the case.
So that's our number two. Yeah, you want to get into what happened with the banks this morning, or earnings, the beginning of earnings season in general?
Yeah, so we had a couple of big banks come out and report. Wells Fargo reported first quarter revenue of 20.7 billion. Expectations were 20.1. Earnings are 4.9 billion, up from 3.8 a year ago. PNC Bank, so we're talking about the regional banks and risk of that kind of those bank failures. First quarter revenue 5.6 billion, earnings of 398 a share versus expectations of 366. And the aforementioned JP Morgan Chase record revenue reported 12.6 billion or 410 a share, which is up from 8.3 billion or 263 per share from the same period a year before. And that well exceeded expectations. Analysts were expecting only 341 in earnings versus the 410 reported. So bank earnings are still showing resiliency. We're not seeing any kind of fallout or contagion from the SVBs, Signature Bank, et cetera, fallout. There were a ton of deposit inflows for the too big to fail banks, which was not a surprise. But I think the earnings coming in beating expectations were the big factor.
Yeah, you may be right that could cause a Fed pivot. My stance has been I thought they'd only do one more 25 basis point hike the rest of the year, probably in May, and then slow. I'm sticking to that tentatively, but and we'll see how the rest of the earnings season goes. But good start for the banks, which maybe put a bug in the Fed's minds, because they'll take any opportunity to hike rates some more. But how pivotal overall, not just banks, do you think this earnings season is, in terms of moving closer towards whatever version of a recession we get? Do you think the importance is overstated, or what do you think?
I think the importance is there for share prices, but probably not for the broader economy. A lot of the big tech names are still trading at really elevated valuations. That's been the sort of flight to safety, safe haven zone for investors. Is all right, well, we'll just buy big tech. But I think what we'll see with earnings is a clearer picture of what the actual economy is doing versus what investors are always focused on, which is, right, for the last year has been, what's the Fed doing?
Right.
So this season we probably get a clearer picture of what the actual economy looks like. And right now it still largely looks strong. But today was really the first day of earnings, so it's premature to make any kind of assessment.
Yeah. That brings it to our number three and our big three, also bank related. Warren Buffett, your boy, uh, came out and said, no one will lose money depositing to a US bank. Bold statement. Is he right? He was right about a lot of things. 08, 09 recession. In fact, I think he influenced a lot of them. What? How accurate do you think that statement is? Is bank contagion over with?
I think it's accurate.
I agree.
I mean, so Buffett he's sort of I don't want to say speaking out of both sides of his mouth because that's sort of unfair, but he invests in major banks. He has a vested interest in making sure that there's not this sort of like outside existential risk for maybe some smaller banks or for some regional banks. Berkshire, I don't have the holdings right now, but I know at times they've been invested in PNC and some of the other banks that famously bailed out Goldman back in the financial crisis. So
Right.
he is a bag holder. He holds banking assets. It's in his best interest to make sure that consumers aren't running for safety, aren't running around with their heads cut off, or like chickens with their heads cut off, etc. But I also think he's right. I know Yellen was hesitant to say that all the deposits are going to be guaranteed, but with as heavy as a hand as the Fed and Treasury Secretary took bailing out Silicon Valley Bank, that's sort of setting a baseline for how they would behave in the event of further banking sector weakness or an actual like banking crisis that's driven by contagion and not just a bunch of people in Telegram tweeting it or messaging each other to pull their money out because SVB is going under.
Yeah, it's so much of it just psychological. I think this lull for weeks where there hasn't really been any trouble for any regional banks helps just in terms of when people are panicked, that feeds on itself and people start pulling their money. And then today seems like a pretty good start. It's just a few banks, and maybe next week there'll be some bad earnings results, especially from regional banks. But as of now, in terms of setting a tone, I think people have mostly moved on from the bank crisis, and that's a big part of avoiding any further contagion, I think.
Yeah, I think that's a very good point that you brought up with earnings having only come from the big banks so far, because those banks are best positioned to keep driving earnings growth in this environment because they're super safe. So they're not competing on yields, right? Your checking account that pays 0.25% at Bank of America or Wells or wherever, if you're at a regional bank, you have to pay 1.5% because you're attracting depositors. Wells Fargo just has to raise their hand and say, hey, we're a structurally important bank. We're too big to fail. You can safely deposit your money here. Who cares what yield you're getting? So they're attracting a ton of deposits and also earning more money on those deposits than regional banks will. Maybe we see something with the regional banks reporting where they're showing weakness, where the big banks that we've seen so far have shown strength. I don't know, but it'll be an important thing to watch.
Yeah. Well, so let's move on from our big three. We are going to Street Check periodically have a guest. We have 10 analysts at Cabot, so we're going to rotate through a lot of them. We'll also have outside guests at times. And today, our very first guest, by special request, because he is Street Check's #1 fan, Jacob Mintz. He is our options trading expert, longtime options trading expert. He runs our Cabot Options Trader, Cabot Options Trader Pro, and Cabot Profit Booster advisories. Jacob, welcome.
Well, thanks very much for having me. This is quite the honor to be the first guest on Street Check. I can only assume you chose me because I'm the most charismatic of the Cabot analysts. I have the best feel for the market, and I just my voice is just made for podcasts. It's either that or potentially all the other analysts are busy and or traveling. So thank you very much, Chris and Brad, for having me on. I appreciate it.
Yeah, thanks for joining. Yeah, half the team is out of town. Brad, what do you have?
I mean, I just thought he had the best face for
right out of the
podcasting.
gate,
So.
Brad or Chris.
Well, I was in the middle of an insult and you just jumped right all over it. But
best face for podcast. But remember, this is also on video, so he refutes that just by being on video. Jacob, so we'll get to the market, your take on the market and options slant on it in a minute. You spent, was it close to a decade on the Chicago Board of Options trading floor prior to Cabot? How did you end up here?
How did I end up at Cabot? That's a good question. So, well, I left the trading floor about, I don't know, 12 years ago, approximately. And just then, so I was just trading at home, and my wife said to me, you know, there's something called LinkedIn that's become really popular. You know, you're doing fine trading, whatever, but, you know, everyone's getting on this LinkedIn. So I said, all right, I'll put it, you know, I'll take a picture of myself and I'll submit, you know, whatever fields they need for that. And, you know, a month later, Cabot reached out to me about the options analyst job. So I, you know, I responded, and Tim Lutz, the former CEO of Cabot, interviewed me just, you know, over the phone. And it turned out I got second place. So I did not get the job. I wasn't even really looking for the job, but, you know, it was just one of those things. I was like, yeah, whatever, I'll take a shot. And I did not get the job. But as a consolation prize, Tim gave me I think it was a 6-month free comped subscription to Cabot Options Trader, which was nice, but whatever. I didn't really give much thought to that. And, you know, I was reading it, I was looking at it, and after a while, I said, God, this is just not great. So, and just being you know, just an open and honest person, I decided to email Tim. I was like, you know what? You know, no hard feelings. I'm not trying to start anything, but I was like, this just really isn't great content. And Tim said, immediately emailed me back and said, can you come up here? We'd like to move on from the analyst. And yeah, so I came up, I interviewed with Tim and Mike Santolo, and lo and behold, that's how I ended up at Cabot.
Wow, I had not heard that story. This is where your role as perennial ombudsman, you know, helped you out, literally got you a job.
Yeah, I mean, I don't have I don't have a very good filter, and if I think something's, you know, not great, I'll just tell you. So, and on that note, Brad, you may regret having me on, because I listen. So you guys, for those that don't know, Chris and Brad, I give them a lot of credit. They've started this podcast. You know, it's not an easy thing to do. So internally, they had a podcast about 2 weeks ago, and I listened to that podcast. So big credit to you guys for doing this. But Brad, you said 2 of the dumbest things I've heard in 2023. So buckle up, big boy, because that bar saying 2 of the dumbest things I've heard in 2023 is pretty low, because I have 2 teenagers who, you know, regurgitate everything they say on TikTok as fact. So what you said, and let me quote this, I wrote this down. You said to Chris, really? Is Uber better than the old school taxi? Well, that's, I'm not sure if you ever lived in a big city, but I lived in Chicago for 10, 12 years. And I don't, you know, yelling and screaming and raising my hand, trying to get a taxi for 20, 30 minutes when it's snowing and the wind's blowing in your face. Let me just tell you, Uber is way better than an old school taxi. So that's number one. You said
I think Brad was shorting Uber at the time, probably.
Yeah.
Yeah. No, I'm just pro public transport. Just take the L, man. Come on.
I'm too good for the L, Brad, but thank you. No, I took the L for many years. And number 2, you said, what about the internet now is better than it was 20 years ago? So that's your second take. Now, I was listening to this podcast on the way back from a spring break trip to Charleston. So I can tell you, just on that trip, I made some mental notes. So I have, first, on that drive, we were listening to Apple Music and Spotify the whole way. That was not a thing 20 years ago. The kids were watching movies on Netflix and Hulu on those apps. I can guarantee you that wasn't happening 20 years ago. And thank God they do, because, you know, that was a peaceful drive. We didn't have to use a map. We were, when we were making restaurant we were looking up restaurants, we found reviews in the in 2 clicks, and then another 2 clicks, we made reservations. So that was awfully nice. We took one of those carriage rides through Charleston, and we tipped our guy using Venmo. That wasn't a thing 20 years ago. And finally, I was able to monitor the market and, kind of work still while I was at a remote location. So yeah, the internet's a little bit better than it was 20 years ago. 20 years ago, that's not too far away from dialing up the dial-up. So anyway, sorry to go after you, Brad, but
So now that I've been ambushed without the benefit of context at all, let me clarify a little bit here.
No, Brad, you're not allowed to. I'm the guest. You have to take the L.
I don't know if we have enough time.
That's podcast 101.
What you're talking about is the ability of the internet to deliver content, right? Like music streaming exists. Like we had Kazaa and LimeWire. You had the ability to get the music. You had the ability to download the video and to save that to devices even 20 years ago. You just didn't have the bandwidth for it. In the context of that conversation, the question was, what actual tech innovation has materially changed your in the intervening 20 years? The standing on the side of the street hailing a cab, yeah, that's different. That's something that I never really had to deal with. Out west, they build horizontally and not vertically, so you don't have much density in the cities. So I'll concede that point. But otherwise, is my banking online better now than it was 20 years ago? All I'm doing is checking account balances, maybe setting up a transfer, checking the market. You could do that 20 years ago. And yeah, you didn't have Wi-Fi, but what I'm talking about specifically in that context was the actual economy of the internet isn't materially different. Yeah, you can order a pizza using Instacart or using Grubhub instead of ordering a pizza through pizzahut.com or whatever website I think they had a link on AOL used to be able to order through. But there hasn't been
AOL is a key word there, but go ahead.
I don't think there's been any real innovation from the economy of the internet, rather than improved delivery mechanisms for content volumes. That's my major takeaway. But
any retort, Jacob, before we actually move on to market stuff?
No, you gotta take the L. That's just the end of it.
Okay.
Like he said, you should take the L. You're telling him to take a different kind of L. Okay, so part of what has
before we move on, I have to say one thing. Jacob, just as a follow-on to how you got to Cabot, you are actually the reason that I am at Cabot.
Oh.
Because when I
apologize to all involved. I'm sorry.
When I saw the job post, I'm like, okay, well, I've seen investment advisories before. I was, broker for about a decade. And then I was like, all right, well, it's all going to depend on the quality of the writing. And I was like, oh, this options guy, I really like what he has to say. He's very, very forthright. He has some good educational content, good explaining content. I'm like, yeah, I'll give this a shot. I like what the Cabot offerings, and that was because of you, Jacob. So you're here. You have an interesting story that brought you here, and you happen to bring me here as well. So this podcast wouldn't exist without you.
Thanks, Brad. That was very touching.
I see you're tearing up.
Do you take it all back now, Jacob?
No, I stand by it all. It was all.
Yeah. Okay. Let's move to the market. Jacob, one of the things that sort of sets you apart as an options trader, how you and your subscribers routinely beat the market. You monitor unusual options activity. You have an unusual options activity scanner. Talk about what that is and how it gives you an advantage.
Sure. So that's a good question. So the way I came up with this thesis is when I was on a market maker on the trading floor of the CBOE, it was my job to make markets. So I would be standing in the crowd, and let's say Google was one of the main products that I traded in. So it was my job to make a market. If Chris or Brad wanted to buy or sell an option, it was my job to make the market and provide that liquidity. So, I like trading against Chris and Brad. They'll buy 1 contract, 5 contracts, 10 contracts here or there. Typically, it's not, they're typically not considered smart money if it's a buy of 1 contract or 5 contracts or so. But if Goldman Sachs comes running in the crowd and they want to buy 1,000 contracts, 1,000 Google calls, 10,000 Google calls, well, now there's some real money at risk. And in theory, they might have an edge. Perhaps it's insider information. Perhaps they know an upgrade or downgrade is coming. So, there's only so many times where I would sell 1,000 calls in Google and watch the stock rip $20 or $30 and lose money as the market maker before I was like, you know what, I'm going to go with the flow. If Goldman Sachs is buying 10,000 calls, I want to be buying calls also. I want to be buying the stock also. So that's really the thesis behind following unusual option activity. Now, so that's what I basically do at Cabot Options Trader. All day, I'm just watching my trading screen. I set up an algorithm of sorts to just watch every unusual option trade that comes across the market. So that's what I do all day. And so, what I'm really looking for is not just a buy of 10,000 calls, let's say. I'm looking for somebody to buy 10,000 calls today, 10,000 calls tomorrow, 10,000 calls the next day, and really putting millions and millions of dollars to work in a trade. That, along with a strong stock chart, a strong market, that's a great signal for me to get into a position. So that's what I do all day. It's my job to see those trades, dig a little bit deeper into them, and then pounce when the risk reward is right.
And by doing this, you can sort of take the temperature of what's going on in the market underneath the surface, if people are buying and if people are selling, right?
Totally. Yeah, that's what I do all day. Every day, every morning I send to Cabot Options traders, subscribers, the list of unusual option activity from the previous day. And at the top of that list, I put like a barometer, like a temperature check of sorts. So if there's big call buying in JP Morgan and Apple and all the big players, the big stock players, then I'll move the barometer towards like a bullish stance. If there's big put buying, like there was big put buying in all the regional banks just 3 weeks ago, well, my barometer dropped to a 1 on a scale of, or a 2 on a scale of 1 to 10. It was ice cold. So that made me get a little bit more defensive. So that's a way that I get a look at the market all day, every day. And then I share that with Cabot Options Trader subscribers.
Hey,
And
Jacob,
where are we generally now? Sorry, I'll let you go.
I'll answer your question real quick, Chris. We're kind of in the middle. It's been generally a 4, which is slightly bearish, a 5, which is mixed, to a 6, which is bullish. So it's just been kind of mixed for the last couple of weeks, which kind of, it's kind of what the market's been doing. It's been choppy and kind of sloppy for the last couple of weeks. So I haven't seen big money piling either really bullish or really bearish. Now, there was, like I said, really bearish option activity about 3 weeks ago, right as the banking crisis of sorts was starting. So I guess it's kind of positive we're back to a neutral stance. So I'm not pushing really aggressive bullish or bearish with the portfolios right now. I'm kind of waiting till earnings season really gets going. And the market maybe breaks out of this range in either direction.
So one thing I wanted to touch base with you on is Chris and I had talked in, the aforementioned sort of lead up podcast about the thesis that there's been a flight to big tech as the safe haven, and it came up organically earlier in this episode. Have you seen option activity that supports or that refutes that narrative? It's certainly something I've seen more headlines about in the last couple of weeks.
So that's kind of a tough one, because unfortunately there's just like in a stock like Apple, let's say, or Facebook, those stocks trade so many options. It's kind of muddied of sorts. Let's say Apple might trade, I'm just gonna make a number, 1 million option contracts a day. Whereas, so that's a hard stock to get a read on. Instead, I try and focus on, kind of the stocks on the next tier lower in terms of size. So I don't know, maybe a Boeing or, CrowdStrike or Zoom. We're on a Zoom call, that type of stuff. It's a lot easier to get a read on option activity. I will say NVIDIA had a ton of option activity before the stock ran up, and well, it's cooled off a little bit. And so, no, I have not seen a dramatic, I don't have a great read on those mega caps tech stocks, but ahead of earnings, I will definitely get a better read as traders kind of line up their positions ahead of earnings. So I would say it's very mixed right now. I know that's not a great answer to say, I don't know, but I don't know.
Yeah, that's fair. It's certainly how the market, feels, right? Like if you're just sitting here and staring at tick charts all day, it's like, all right, well, it's choppy again. No big impetus to push higher on the market as a whole, but some of these individual issues are maybe running up. But it's just sort of a wandering market, I guess, kangaroo market, just sort of bouncing up and down.
I will say,
it's anecdotal, but
yeah, I will say, one thing that I do, our portfolios are pretty light on positions right now, and I tend to have light exposure to the market ahead of earnings season. Because one of my best strategies has really been pouncing on these earnings season winners. So, there's going to be some stocks that bomb this earnings season. I can guarantee it. And I might get caught in one or two of them. That's just earnings season. But I love seeing these stocks that report, blowout earnings, and the stock explodes higher. More times than not, those stocks, you look for those new earnings season winners. That's where the real money is made. I think ON reported blowout earnings a couple weeks ago. That's kind of an intriguing name. Those type of stocks that had chopped around and then just exploded on blowout earnings. That's kind of where I want to be. And I know the Cabot options trader portfolios are going to be adding a lot of exposure to those type of stocks in the coming weeks.
And you mentioned earnings. Andy Crowder, who is our other options trader, he often will make, actually as a whole service dedicated to making earnings trades, short trades, betting on which way a stock, or betting that stock won't drop or rise too far after earnings ahead of time. Do you ever make trades ahead of earnings, or is it always sort of in reaction to earnings?
Generally, I try to avoid earnings. I know what Andy's doing, and it totally works. It is a sound strategy. He's essentially selling option volatility. The price of options gets very expensive ahead of earnings, because earnings are the great unknown, and the stock is potentially going to make a big move. So the price of options, which you can think of in terms of like insurance, let's say, if you think a hurricane's coming towards your house, which is in this metaphor earnings, if you think that hurricane's coming, you're going to want to buy a lot of insurance to protect yourself. So the price of options, in this case, get very expensive. So Andy sells those expensive options, assuming that the stock won't make that dramatic move, that the hurricane's going to miss your house. So I generally don't put on earnings plays. No, I just wait. I tend to buy options, and it's a bit of a challenge. I don't like predicting where a stock is necessarily going to go on that option, on that earnings move. So that's really not my game.
Right. And one important note with Andy's process is he also closes those pretty much immediately. So when Mike looks at Santolo, Cabot Growth Investor, looks at accumulation of stocks after earnings, when Jacob is looking at like the big options activity after earnings and price movement after earnings, that trend is stuff that Andy avoids entirely. He's getting the premium ahead of time, and then he's essentially out. So it sounds more like you guys are on opposite sides of the trade than you actually are. Just a totally different approach to it.
Yeah, I mean, there's a lot of ways to. I mean, options have exploded in popularity in the last couple of years, and the reason really is because there's the difference between Jacob and Andy. Jacob is looking to buy calls and run a stock up as high as possible, make a 200, 300, 500% gain on a position, whereas Andy is looking to sell insurance essentially and just make 5% here, 10% there, be in and out of the trade. So that's really why options are so popular these days. Is there's a lot you can use options to make money in all types of environments. So that's we both appreciate each other's systems, but we take opposite. We use options completely differently, which is totally fine. We both are successful at it.
And Brad, you mentioned Mike. That leads me to what I wanted to bring up. As you said, Mike is our resident growth investor, and he runs a service called Cabot Top 10 Trader, where every week he recommends 10 of the best momentum stocks in the market. Now, Jacob, you have a service, so that's on Mondays. On Tuesdays, you have a service that chooses one of those stocks and makes a covered call trade on it called Cabot Profit Booster. Do you want to talk just a little bit about that?
Sure. I mean, I'm basically piggybacking off Mike's hard work, and he'll tell me all about that. So I basically Mike is great at picking stocks. He's great at reading the charts. He has defined stop levels, and so I picked one of the stocks that Mike really likes, and I sell a covered call on one of those stocks. That a covered call is a way to essentially to get bullish bullish exposure. And if the stock chops around, I will sell a call against that, and it works. If the stock goes up, it works. If the stock chops around, it works. It's just a way to collect one of those kind of insurance premiums against a stock position. So I release that. Mike releases top 10 trader on Monday nights, and Tuesday morning I sell a covered call against that stock that he recommends. I give Mike's full write-up. I use his stop levels, his charting, and then I give the option trade. And covered calls are really the best way to get started in options. It's a very safe strategy, and it's just a good way to collect those yields, those 3, 5, 8% yields month after month.
What duration do you gravitate towards with Profit Booster?
So I tend to sell calls that are expiring in a month or two. That's just options that are expiring in the next month, the next 2 months. Those options are losing value at a very rapid rate just because expiration is coming. So it's really looking to hit and run. I'm not getting out of that trade in a couple of days. If it's working, I'm riding it out for a month. And yeah, we're going to get we'll have 4 to 5, 6 trades on it at one time. Those trades will expire, and we'll just keep rolling new positions in every single month. Every single week.
And again, that's Cabot Profit Booster for anyone who's interested. Like Jacob said, issues come out every Tuesday morning. If you're interested, that's on the cabotwealth.com website. You can go to the advisory pages and learn how to sign up for Cabot Profit Booster there. Jacob, before we let you go, give us your best Chicago Board of Options trading floor story from your days there. I know you have a lot of them.
Well, my best. If I want to come back, I'm not going to give you my best. I'll just give you one
that's for an audience.
Yes.
Don't worry, Jacob. I never expect your best.
Right. Thanks, Brad. And Brad might not want me back after my initial playing of them. Okay, so I'll just give you one. So I guess it's just the start of my trading career of sorts on the options exchange. So after college, I was hired to be a clerk on the options exchange, which with the expectation that after I learned with 2 trading floor legends that they would put me on a seat, which means I would become a market maker. I was going to learn for a year, I was going to stand by these guys, and then I would become a trader. So when it's time for me to become a trader, now I have to choose a pit. So there's trading crowds all over. So one trading crowd, every trading crowd had like 30 or 40 stocks in it. So one trading crowd, the big stock would be Bank of America. The next trading crowd, it would be Google, and so on. So when it's time for me to pick a trading crowd, now I do want to give some context. I was 23 at the time when I was going to walk into this trading crowd. I was 23. 5'11", maybe weighed 165 pounds. I probably looked like I was 15. I had just a little bit more hair back then. So I was not exactly the intimidating force walking into a trading crowd. So I walked in the trading crowd, and it was my job to kind of break in. Now, these guys didn't want me in there because if I started getting on the trades, that meant that they were not getting on as many trades, or I was taking pieces of their profit. So as you might imagine, they were not particularly kind to me, and that's expected. It didn't matter that I looked so young, but I would start to make a market. Let's say I would start to yell something out, and they would be screaming in my face. I mean, absolutely, spit flying in my face. Their red face, just giving me the business. So that was kind of the way you break into a crowd. Is you just have to. You had back in the day before things were electronic. You had to be the first person on a trade. You had to be the loudest. You had to be the fastest. And so, in the beginning, I wasn't the loudest and the fastest. But as I got, more and more experience, I became the fastest. I became the loudest. And I knew I broke into the crowd officially one day when I made a market, and the guy was screaming in my face. It's like, "Bob, what's your market? What's your market? What's your market?" I gave him the market. I said, "Buy him." I said, instead of saying, I'll sell you 1 or 2 or 10, I said, "I'll buy 1,000." And that shut him up real quick because he knew that I had officially grown into my role of sorts, and he didn't want to sell me 1,000 of those contracts. So it was a rough environment there for a long time. It was a lot of I would say in the beginning when I was there, it was a lot of, not to stereotype, this was in Chicago, it was a lot of Southside Irish guys, a lot of North Shore Jewish guys. There was all types of these cliques, and if you're breaking in and you're trying to take money off their plates, they were not having it and they weren't happy about it. So it was a rough couple, 6 months standing there in isolation while 40 other guys were having fun and talking and going to lunch together, and I'm just standing there, just trying my best to break in. It was a little rough, but here we are. It turned out to be a pretty good career for me.
Yeah, I could see why you wanted to come to Cabot and work from the comfort of your living room, where only your kids scream in your face, and that's only occasionally. Yeah.
Now I will say that later as my training career went on, there was one guy who came into, I was at this point 8-10 years into the career, and I was at the bottom of the training crowd, which was closer to the broker, where you could get his attention more easily. One guy tried to break in, who was an experienced trader, and he stood behind me and he screamed as loud as he could for weeks, and my ears every single day would be ringing, and I literally think that I had got a little hearing loss because he was screaming all day, every day in my ears, not attacking me or anything. He was just trying to become, one of the guys in the crowd. That was really the way to do it. So it was the best of times, and there was some worst of times also.
Yeah, I could imagine.
It sounds like a nightmare.
Yeah,
it was. But I would go back there in the blink of an eye. Trust me.
If you could make 20 or 30 cents on a spread and not a nickel or a penny or whatever, I assume.
Way more than 20 to 30 cents on a spread. I mean, we were talking for a lot of these stocks, dollars, multiple dollars. I mean,
wow.
One of my biggest trades. Yeah, I mean, it was the Wild West. It was back when the Chicago Board of Options Exchange was the only game in town. Those spreads were miles wide. Especially in the liquid stocks. In a Bank of America, a spread would be 50 cents wide, let's say. But in some random tech stock, it could be $5 wide. So there was a lot of edge, and there were some trades that were quite lucrative.
Yeah, that's crazy. I started my career right in the teeth of the great financial crisis. So I remember there was a trader that I worked with that used to talk about how on triple witching Fridays they would bring a keg into the office just because they were having to handle so many expirations. They're placing so many trades. Part of me does wish that I could go back and see what the Wild West version of finance was. That was something that I unfortunately missed out on.
Yeah, I wouldn't say it wasn't exactly like the Wolf of Wall Street, but there were certainly some parties that I'll save those stories for the next podcast. So that'll make you make sure that you have me back with those.
Once we get to the PG-13 versions of these podcasts,
right.
Do that. Well, thanks, Jacob, for joining us, and thanks for sharing. We will be back with the next episode of Street Check next Friday, assuming Brad's out of therapy by then. But for Brad Simmerman, Jacob Mintz, I'm Chris Preston, and we'll see you next time.